Normally, when you go and apply for a mortgage, you give them all your information, your credit, how much money you're putting down, and they're going to look at it and say, hey, the going rate at this time is 7.5%. That is what the bank or the investor is willing to offer someone in your credit situation. When we say buy down the interest rate, what you're doing is you are actually purchasing discount points or buying the rate down to a lower number. So instead of a 7.5, they might say for $5,000, we'll allow you to get a 7% interest rate. What we do then is we do what's called a break-even calculation. So if a 7.5% interest rate is one payment and the 7% interest rate saves you $100 a month, let's say. If it's cost you $5,000, $100 a month savings divided by the $5,000 is 50 months. If you're going to be in that home for over 50 months, makes sense, because then every month after that, you're saving money. On the other side, if you're like, well, this is a 2-year home for me, probably doesn't make sense to buy the rate down. Or what a lot of people don't think about is, are rates going to go down in the future? Can I refinance later? If you buy a rate down to a 7 and 2 years later, interest rates drop to 6 and you can refinance, you spent $5,000, that money's gone. And now you can just refinance to a 6. So always make sure you're thinking about it. It's different for everybody. Some people it makes sense. You need that $100 of savings for your budget. If you need it, I would never tell you not to do it.